So now this is a follow-up to the video I did on mortgage discrimination. After I posted it, there were several people who reached out to me letting me know that they had experiences similar to mine. And their number one question was, okay, now how can we make sure that if this happens to us, we can ensure that we still get the value that we need for the appraisal so that we can get the appropriate amount of money out that we can do and do what we need to do, whether that's on the investor side or homeowner side. Unfortunately, there's really no easy answer to this. And the reason being, if you look at an appraisal that you get, you'll see that the client of the appraiser is actually the bank. So now, although you pay for the appraisal out of pocket and you pay that money to the bank, or sometimes you'll even pay that money directly to the appraiser, the client for the appraiser is the bank. So what that means is that now you have limited claims on anything that the appraiser finds or the value that they assign, because there's a little section in the appraisal that says this is intended only for the purposes of the client. So now the client is the bank. And the bank, they say, okay, well, this was the value that they gave us, and then we'll lend based on this value. So because the client is the bank and not you, even though you pay for it, there's limited repercussions. So now what does that mean? That means that, once again, if you get a low value and you go and you want to sue the appraiser directly, you can't sue the appraiser because you're not the client of the appraiser. The bank is the client of the appraiser. And therefore, you have to be able to show mortgage discrimination in order for you to be able to sue the appraiser. And now the reason for the bank being the client of the appraiser and instead of you being the client of the appraiser is so that the bank has or that the appraiser is liable to the bank. So what that means is, let's say the appraiser gives the bank a value that the house is worth. So the bank lends on it. And then for whatever reason, let's say 6 months to a year later, you can no longer pay the mortgage. So you have to default on the mortgage and it goes into foreclosure. They take it back and then they want to sell it. So now if there was no material change in the condition of the property or the condition of the market, and they find a buyer and the buyer's appraisal comes back a lot lower, so the bank has to sell that property for a lot lower, they now can go back to the appraiser who appraised the property before you bought it and then sue them and say that they gave a bad appraisal, that their appraisal was not accurate, that they gave an incorrect appraisal. They can sue them basically for errors and omissions because the appraiser wasn't competent enough when they gave that appraisal for them to not let them lose money. So if you see, it's the corporation that has all the power instead of the person who's actually paying for the appraisal that has the power. So because of that, once again, you have to make sure that you can prove mortgage discrimination in order to have a claim against the appraiser. And in order to even start that process, you have to file a claim with your state's mortgage appraisal, with your state's property appraiser board. And so some things that you can do to kind of help you out. So one person asked, hey, I took a hard money loan out before I was approved for the loan. My lender did an appraisal, a post construction appraisal, just to make sure that they knew the property or the value of my property. While you can try to use that in some circumstances, it may work, it may not work. That may be a shot in the dark. And the reason for that is because most banks, when they lend on a property, they have a seasoning period. And what that is that's a period between when the property was last funded, so either bought or refinanced, to when another bank will fund or refinance it again. So typically, as you buy a property, that seasoning period is about 6 months if you're going to refinance, meaning most banks want to see that you held the property in your possession for 6 months before you refinance. There are some banks that may do it beforehand, but then once again, they'll want to see all of your receipts, and you have to make a case to show them how in a period shorter than 6 months, your property jumped in value exponentially. But typically, 6 months is what most banks use for their seasoning period. And when appraisers look at comps, typically they'll look at comps somewhere between 3 to 6 months. So what that means is, even if you give that appraiser, or you try to contest your appraisal with the appraisal that you got when you got your initial loan to purchase and renovate the property, they'll look at it and say, okay, well, these comps are at least 6 months old, so they're out of date. I can't use them. Sorry. That's on the bad side. The good side, they may look at it and say, okay, fine, I'll give you the same value. So it may work. However, appraisers don't have to use that because it is going to be at that point that you give it to them at least 6 months old and outside of the range of comps that they like to use. The other thing that you can try to do is, some people say, we'll meet the appraiser there with your list of comps that you've looked at previously, give it to them before they do the appraisal, and then when they take it back, they may use those as they go and do the appraisal. That may happen. It is definitely worth a shot. However, once again, sometimes you have appraisers, they look at it as, they had to take tests, they had to study, they had to get licensed for their job. So they're going to look at you, especially if it's, those smaller residential deals, as, non-sophisticated investors. Okay, well, you don't really necessarily know what you're talking about. Yeah, this is good, but I'm still going to do my own research to find out what the value is myself. Once again, it's also because their liability is not to you, it's to the bank. So you can give them a list of properties all you want, but at the end of the day, they know that they're still going to be on hook to the bank if anything goes wrong and the bank comes back to sue them. So they're going to make sure that they cover their own butts. And then lastly, one of the things that you can also try to do is you can pay for an appraisal before you go to refi. So what that is let's say maybe, so you have that seasoning period of 6 months. So maybe a week before that 6 month period is up, you can go order your own appraisal and have a appraiser come out and appraise the property, and then go to the bank, submit your application, and then once the bank orders their appraisal, they'll come out. You can meet that appraiser and then give them a copy of the appraisal that you ordered. That's something that can potentially work because, once again, you're within the same window, because if you ordered that appraisal a week before, you then went and submitted an application to the bank and had the bank come out with their appraiser and send their appraiser. What that does, that week over, or just that week difference, should be short enough period where they're going to both use the same comps. So if the appraisal that you ordered comes back at the number that you want, it'll be harder for the appraiser that the bank ordered to say, okay, well, it's significantly lower than what this other appraisal is that was just done a week ago. However, once again, because the client for the appraisal that you ordered will show as you, if that appraiser wanted to use a different value, they still could, because once again, they're going to go off of the Appraisal Independence Act and say, well, this appraisal that you used or that you gave me was ordered by you, so we don't know if there was any sort of manipulation that was done when you were talking to that appraiser to have them give you a higher value. So because we have to be independent, we're going to go off of our own comps that we pulled. So once again, it's something that can potentially help, but is not necessarily bulletproof because of number one, you order the appraisal yourself and it'll show you as the client of that appraiser, so they may not necessarily recognize that as a valid appraisal. And then number two, the whole reason that, once again, that appraiser is liable to that bank, because the bank that's ordering the appraisal is their client. So they have to make sure that they cover their butts. So they're more so worried about making sure that they're covered with the bank and that lawsuit that can come regardless, as opposed to making sure that they give you a fair value.